It's one of the strangest truths in finance. Some of the smartest people still lose money. They read the charts, understand the numbers, and know the theories. Yet their portfolios crash like everyone else's. Because in investing, intelligence alone isn't enough. Psychology decides who wins. The market doesn't just test your strategy, it tests your emotions. Fear, greed, impatience. They all live in the same brain that makes your decisions. And the moment emotions overpower logic, brilliance becomes blindness. That's why so many smart investors lose. Not because they lack knowledge, but because they lack control. Because the hardest person to beat in investing is yourself. So today, let's uncover the psychological traps that destroy even the best investors and how to overcome them before they destroy you. Because once you master your mind, the market can no longer manipulate you. 1. The illusion of control. Thinking you can predict the market's smart. Investors love data, charts, and analysis, but too often that confidence turns into illusion. They believe they can predict what comes next, as if logic can control chaos. The truth? No one can consistently forecast the market. Not experts, not analysts, not algorithms. Markets are driven by millions of human emotions, not just numbers. And when investors start believing their intellect can outsmart randomness, they stop respecting risk. That's when overconfidence creeps in. And overconfidence kills faster than ignorance. Because prediction feeds ego, but patience feeds profit. The best investors don't try to control the market. They prepare for it. They build systems, not predictions. Rules, not guesses. Discipline, not drama. When you accept uncertainty, you stop gambling and start investing with clarity. 2. The greed trap. Mistaking luck for skill. After one lucky win, even the smartest minds start believing they've figured it out. That's how greed disguises itself as confidence. They double down, take bigger risks, and start chasing more. But the market doesn't reward arrogance. It punishes it. Every bull run convinces people they're geniuses, and every crash reminds them they're human. Greed blinds you to risk, seduces you into leverage, and whispers that this time, you can't lose. But no one beats the market by emotion, only by endurance. True wealth isn't made in explosions of luck, but in quiet seasons of consistency. The real pros treat wins like warnings, reminders to stay humble. Because the moment you think you've mastered the game, the market changes the rules. 3. The fear reflex. Selling low and buying high. Fear is the most expensive emotion in investing, right? And even smart people aren't immune. When markets crash, logic fades and survival instincts take over. You sell not because it's smart, but because it feels safe. Then, when prices rise again, that same fear turns into FOMO, and you buy when it's too late. It's a vicious loop driven not by ignorance, but by biology. Our brains evolved to avoid danger, not to handle volatility. That's why the market preys on emotion. It knows fear sells faster than logic. But here's the paradox. The moments that feel most dangerous are often the most profitable. The best investors train their emotions like athletes, to act rationally when everyone else reacts emotionally, because courage in chaos is what separates the panicked from the prepared. 4. The herd mentality. Following the crowd, losing yourself. Even the most intelligent minds fall for the safety of the crowd. When everyone's buying, it feels wrong to wait. When everyone's selling, it feels foolish to stay. We crave belonging, and that instinct costs fortunes. Smart investors read the same headlines, scroll the same feeds, and slowly start thinking the same way. But the crowd is never earliest, it's always late. By the time something becomes obvious, it's already overpriced. Millionaires are made by moving before the masses, not with them, because following the herd gives comfort, but never wealth. True investors think independently. They make decisions based on principle, not popularity. Remember, the crowd is emotional. The wise are strategic. Don't follow noise, follow numbers, logic, and long-term conviction. 5. The impatience paradox. Wanting quick results in a slow game. Intelligent people are used to progress. They study, work, and see quick rewards. But investing doesn't work like that. It rewards patience, not performance. That's why so many bright minds struggle. They treat markets like exams instead of ecosystems. They can't stand the boredom, the waiting, the months of nothing happening. So they tinker, trade, and chase activity, mistaking movement for progress. But wealth grows quietly, not quickly. Compounding doesn't reward speed. It rewards stillness. Smart investors don't ask, how fast can I double my money? They ask, how long can I let it grow? The moment you stop rushing the process, you start letting time work for you, not against you. Because real investing isn't about action. It's about endurance. 6. The confirmation bias. Hearing only what you want to believe. Once we form an opinion, our brains filter everything to prove we're right. Even brilliant investors fall into this trap, seeking data that supports their view while ignoring the rest. They read articles that agree with them, follow experts who think like them, and dismiss red flags as noise. That's not analysis, that's emotional validation dressed as logic. The best investors do the opposite. They look for reasons they might be wrong. They challenge their beliefs, question their assumptions, and listen to dissent. Because in the market, being wrong isn't failure, staying wrong is. The more you fight to protect your ego, the faster your portfolio bleeds. Wisdom isn't found in being right all the time. It's found in correcting yourself faster than others. True mastery comes when truth matters more than pride. 7. The identity problem. Tying self-worth to portfolio performance. For many smart people, their investments become part of their identity. When they win, they feel brilliant. When they lose, they feel broken. That's the most dangerous mindset of all. It's because the market isn't personal. It doesn't care how educated you are or how hard you worked. The moment your self-worth depends on numbers, every fluctuation hurts like failure. That emotional attachment leads to panic, denial, and impulsive decisions. You are not your portfolio. You are the person who manages it. The best investors detach ego from equity. They can lose money without losing peace because they know control lies in discipline, not result. The market doesn't define you, your mindset does. Detachment isn't apathy, it's strength. 8. The solution. Master the mind, not just the market. Knowledge builds skill, discipline builds wealth. To truly win, you must treat investing as a psychological battle, not a mathematical one. You need systems that protect you from yourself. Automated investments, stop-loss plans, and clear rules. You need patience that outlasts volatility and humility that outsmarts ego. Smart people lose because they think investing is about intellect. It's really about emotion. The market rewards emotional balance, not IQ points. Once you master your behavior, profits follow naturally because the secret to investing isn't beating the market. It's avoiding the mistakes that beat you. Emotions will always exist, but discipline decides who controls whom. The investor who conquers himself conquers the game. The smartest investors don't try to outthink the market. They outlast it. They understand that psychology, not strategy, is the ultimate advantage. Because in the long run, the calm mind beats the clever mind. So the next time fear or greed whispers in your ear, pause. Remember that every emotional decision is a shortcut to regret. The market doesn't punish intelligence, it punishes impatience. Your edge isn't what you know, it's how you behave when everything you know stops working. If this opened your eyes, hit like, subscribe, and share it with someone who confuses knowledge for wisdom. Because the truth is, you don't lose money because you're not smart enough. You lose it because you're not calm enough. And once you master your emotions, wealth becomes inevitable.